Income Tax 2020, Schedule C, Car and Truck Expenses. Come in, relax with Income Tax 2020. Schedule C, Car and Truck Expenses. With regards to a Schedule C and our income tax equation, we're going to basically be up top in our income tax equation, remembering that the Schedule C will be a separate schedule which has both income and expenses on it. Basically, the net income or bottom line of the Schedule C then feeding into the top line of the income tax equation, where we then apply the above the line and below the line deductions. The Schedule C having an impact in many areas on the Schedule C, including, of course, the Schedule C and other areas such as the first page of the 1040. As we can see here, the 100,000, which is flowing in from the Schedule 1 Part 1, flowing from the Schedule C. Then we also have the self-employment tax, which is Social Security and Medicare, half of it being deductible as an above-the-line deduction. We could also have a qualified business income deduction as well. Many impacts with the Schedule C. Here's going to be an example of the Schedule C. Now, as we can see down here on the expenses items, as we saw in the past, an expense that is consumed in order to generate revenue is typically an ordinary necessary type of expense that you would think would be deductible. A confusing component all the time is going to be the car and truck expenses because one, you got some confusion as to whether it's going to be business or personal sometimes if you're using one car or truck for both. And then two, there's two methods that you can typically use or you're allowed to use, either the mileage method or the direct method, writing off the direct expenses for it. The mileage method being an easier method to use, but we're going to have some kind of estimates that are going to be involved there. And if you use the direct method, then you got to actually record the depreciation. So many people will then choose the mileage method oftentimes for easier use. You can do both, put both into the system to see which one the system will which one will turn out to be a better one to use. So that's basically the scenario. So we'll run through an overview of those two scenarios. So you're thinking business expense, I have a car, I use it for work, or my client uses it for work. Question, is there any personal use of it? How much of it is using for work? When you're thinking about the miles, are you talking about commuting miles? Or are you talking about miles that are not commuting miles? Typically non-commuting miles are the possibly deductible miles. And then do we want to use a direct expense method, or do we want to be using a mileage method? And part of that will be dependent on what we did in the prior year. Obviously, if they're using the same car, we have some remnants of this idea of consistency. So if you're using the mileage method, or if you pick one method, then you might want to stick with that method. If you go to the mileage method and you chose it in the prior year, then you may have more obligation then under certain circumstances to stay with that, and some restrictions as to jumping back and forth between a direct method and a mileage method. So you're thinking kind of consistency principle to some degree taking effect here. Note that although the 2020 forms are out for the Schedule C, we're taking some of this information from the tax guide for small business, and that still has the 2019 out. So the 2020 tax guide for small business is not yet out. So we're taking or basing some of our information on the 2019 information. We may have made adjustments to it, but just note that a lot of it's coming from the 2019 information. If you have questions about kind of a gray area on it, you can look at the tax guide for small business. The 2020 should be out shortly, and we may put a reference or a link to it, but of course you can find it on the IRS website at irs.gov. The general principles about a mileage method and a direct write-off method and choosing between the two should remain much the same. So we have the car and truck expenses. If you use your car or truck in your business, you may be able to deduct the cost of operating and maintaining your vehicle. You also may be able to deduct other costs of local transportation and traveling away from home overnight on business. Now, as we look at the car and truck expenses, notice that it is an area where the IRS may take a look at it more closely than possibly other areas, because the car and truck expense can be something that could be substantial to the taxes, number one. Number two, there's going to be estimates that will be involved, which mean there could be leeway for estimates to be made or errors to be made within the estimation, and also because it has a business and personal component to it, or possibly could have. Those are all reasons that the IRS could be taking a look at the car and truck expenses. So you want to make sure that you're supporting your documentation for it well, so that in the event of an audit or something like that, you can support your stance on it. So we have the car and truck expense. We have the local transportation expenses. Local transportation expenses include the ordinary and necessary costs of the following. So we got the local transportation, getting from one workplace to another in the course of your business or profession when you are traveling within the city or general area that is your home. Tax home is defined later. So generally, if you have your basically your home, your tax home, you're driving within the general area. Now, notice when we're thinking about the driving miles, there's often a difference between the commuting, which may not be deductible, and driving from location to location, like one location to another, location A to location B, or to clients or something like that, which isn't a static office that will be involved. There's also a distinction with local driving or driving around your local area and travel, which might be then overnight travel, meaning you're traveling for business to some other town or some other location that's not near your primary work location. Visiting clients or customers. So when you're visiting clients or customers, that means we don't really have as much of this problem of questioning whether something is commuting miles or whether it be, non-commuting miles. If you're driving to a customer, that's going to be pretty clearly then a business miles and not basically commuting miles. If you're driving to some other location, which is like a work location, then you got to think, okay, is this commuting or am I driving to basically location 1 or location 2, my primary business location or not? So going to a business meeting away from your regular workplace. So if you're going to a business meeting, so you're not going to a client, it's a meeting, but it's not at your regular workplace. Again, we're distinguishing from whether it be commuting miles to whether it be miles that are not commuting but business related. Getting from your home to a temporary workplace when you have one or more regular places of work. These temporary workplaces can be either within the area of your tax home or outside that area. So now we're thinking, okay, now you're going to a workplace, and the question then is it your primary workplace or not? If it's a temporary workplace, then you would basically think that you could count those miles as something that may be deductible. If it were then your primary workplace, you might be commuting and therefore possibly not included as something that could be deductible for that driving, the cost of that driving. So local business transportation does not include expenses you have while traveling away from home overnight. So if you're going overnight, that's basically going to be moving from local transportation to basically to like travel expenses. So they may be deductible, but we're kind of making a distinction, or the IRS is making a distinction, the code is making a distinction between local travel, local around your place, to travel that's going to be travel, and that'll be basically typically defined by overnight stay for business purpose. Those expenses are deductible as travel expenses and are discussed later under travel and meals. So they'd be under travel and meals, not auto typically. So however, if you use your car while traveling away from home overnight, use the rules in this section to figure your car expense deduction. So we can use the rules here for the car expense deduction. Generally, your tax home is your regular place of business regardless of where you maintain your family home. So we're talking tax home for purposes of your local driving. It includes the entire city or general area in which your business or work is located. Office in the home. So typical question comes up, well, what if my office is in the home? That's going to be my workplace there. Your workplace can be your home if you have an office in your home that qualifies as your principal place of business. So that's going to be like the key term. Is it your principal place of business at home? If it is, then you can think of everything that you drive then for business as you would think something that could be possibly deductible, or the cost of it being then deductible. If it's not, if some other place is defined as your principal place of business, then you would think that driving to that other place that is your principal place of business might be falling under commuting, and therefore the miles that would go from driving back and forth on the commute may not be deductible. IRS then thinking that, or the justification being that, everybody has a commute. If you're a W-2 employee, you don't get to deduct the commute. And if a business, they're saying that you shouldn't, they're kind of aligning that, so you shouldn't deduct the commute. You deduct other kind of miles typically. So methods for deducting, we have the standard mileage method, the standard mileage rate method, and then the actual expenses method. So standard mileage rate is supposed to be easier, and then that means we can just basically count the miles that we have. So we got to track all the miles, be able to explain or justify the miles that we have driven, and then we can use a rate to basically calculate it. versus the actual expenses, which means you actually add up the gas and the whatnot, all the other stuff, and you basically have to depreciate the automobile typically to record the depreciation as part of the actual cost, which can add a little bit of complexity to it. Also note that if you're using the actual expenses, it could be a little confusing to apply out if you're using it both for business and personal use to then have some ratio that you're going to have to use to apply out. But you can also choose to do both of these calculations and then find the one that would best suit you or provide the highest benefit, noting that you could have some restrictions in terms of consistency, meaning you might have some restrictions in terms of jumping back and forth from one method to the other when you're talking about the same automobile from year to year. So we have the standard mileage rate method. Choosing the standard mileage rate. If you want to use the standard mileage rate for a car or truck you own, you must choose to use it in the first year the car is available for use in your business. In later years, you can choose to use either the standard mileage rate or the actual expenses. So if you want to use the standard mileage rate, they're basically saying we want you to pick that rate in the first year. But if you wanted to then jump from that to the actual deductions in a later year, then you may have flexibility to do that. So you have some of that consistency kind of principle in the method that you're going to be choosing. So you want to make sure that to pick up the proper method in the first year. And if you think the standard mileage rate would be the best way to go for overall for the life of the vehicle that in your business, then you might want to pick that in the first year. So if you use the standard mileage rate for a car you lease, you must choose to use it for the entire lease period, including renewals. Standard mileage rate, the standard mileage rate not allowed. You cannot use the standard mileage rate if you operate 5 or more cars at the same time. So if you have 5 or more cars, then that's kind of outside what the standard mileage rate is kind of used to do. The standard mileage rate is typically there for an ease of use, you would think, of people that use their car, but the car isn't their principal business. If you have 5 or more cars, it seems like you're doing something possibly that is that's related to the cars, and then you'd want to track the actual expenses of those cars since they're more essential to your business. So claimed a depreciation deduction using any method other than straight line, for example, acres or makers. These are depreciation methods. So if you claim depreciation that was an accelerated method, so these are accelerated methods of depreciation, then they're saying, well, you already took the advantage of the added depreciation in the first year, and then so like if they let you take the depreciation, people would take the depreciation in the first year, get a huge deduction for the depreciation, and then they would go to the standard mileage method after that and get a higher deduction than they normally would there. And that's why you can't go from the actual method, because you would take advantage of the accelerated depreciation in the first year and then jump over to the mileage method. That's what they're trying to stop. Claimed a Section 179 deduction, so that one's even more front-loading the depreciation. A 179 deduction allows you to depreciate more in the first year. So again, they don't want you to take all the deduction in the first year and then still get all the deductions for the standard mileage rate in following years. So they're going to stop you from doing that. So claim the special depreciation, same thing. Special depreciation allows you to depreciate more in the first year. So claimed actual car expenses for a car you leased or are a rural mail carrier who received a qualified reimbursement. Obviously, if you get a reimbursement, then you don't get the expense because you got reimbursed for it. So we have the standard mileage rate. So parking fees and tolls. In addition to using the standard mileage rate, you can deduct any business-related parking fees and tolls. So you can still deduct the parking fees and toll. Parking fees you pay to park your car at your place of work are non-deductible commuting expenses. The standard mileage rate for businesses, which is what we're talking about here, 57.5 cents per mile. Notice that we talked about charitable deductions. If you're driving for part of your charitable deductions and you could deduct that, it's substantially lower at the 14. And we talked about the medical expenses that you might be able to deduct some of your driving using a mileage method, and that would be substantially lower at the 17 cents per mile. Actual expenses. So now we're moving from a mileage method to the actual expenses, meaning we're going to be counting up the gas and whatnot, saving those receipts, and then having to calculate the depreciation. So if you do not choose to use the standard mileage rate, you may be able to deduct your actual car or truck expenses. Actual car expenses include the cost of the following items: So we have things like depreciation. That's going to be the most confusing kind of component, because that means we're going to put the car on the books basically as an asset, and then we have to allocate the cost over the useful life, and we're going to do that with the form of depreciation. So we got depreciation on the books. We also might have to prorate the depreciation for business and personal use as well. So we'll take a look at those things in future presentations in tax software examples. So we might have garage rent, we might have gas involved, insurance, lease payments, licenses, oil, parking fees, registration, repairs, tires, tolls. These are all types of things that we could then add up for, of course, the actual expenses. So actual expenses, if you use your vehicle for both business and personal purposes, you must divide your expenses between business and personal use. You can divide your expenses based on the miles driven for each purpose. So a common method, I mean, if you're working with a client, would be to be, okay, so how much is business, how much is personal? And if they have counted, they should be tracking, hopefully, that, you know, the miles that they're driving for business. And you can kind of say, okay, well, how much did you drive for the entire year? And then how much did you drive for business? And then you could take the amount you drove by business divided by the total miles, and that would give you an estimate of the miles. Or, I mean, if they don't have that, you can approximate how many miles they drove basically for business. You could say, what do you think your total miles are? And then you might have to say, what do you think percentage-wise would be business versus personal? And then multiply out to determine the business miles versus the total by multiplying that by that percentage. Again, there's some estimates that are going to be involved here, of course, and that's part of the problems with the business vehicle, because there's some overlap between business and personal oftentimes, and that's that kind of gray line in terms of should it be deductible or how much should be deductible and how much should not. So the better documentation, the better stance you have in the event, of course, of an audit, so that you could show clearly why exactly you are taking that. If you have the actual miles documented and you have the actual business miles, then you could take a ratio. If you don't, then you might have to do with some estimates.